Alright, and we are starting over with another episode of BlockreVision today with solely audio effects, but that's a special episode. Special episode is we are at a very important spot on a major US index, that is S&P 500, where we are about to possibly react to the previous bottom of June of 2022, and the double bottom formation is very often been met in trading scenarios where that formation may lead a major pivot to the upside. So before we just take an insight in what's going on the chart, I would like to just concentrate on data, major economic data that may tell us a bit more where we are now at in terms of background behind this recent price action performance. So I will present you the spectrum of ratings from the most leading indicators to the most lagging, and that will show you up where we might be heading next in terms of those price valuations. I would like to at first present you this chart of S&P 500, where previously I have told that this candle that stopped us back in June was the one that hasn't appointed any kind of strong reversal. So we've observed the stop, the chart that stopped to if we just have a look at SPX, I've told that this reversal been met in June wasn't the one of the strongest. So we haven't seen any type of correlation between those two candles that may justify in kind of a stronger reversal. We should observe right here kind of a engulfing pattern that hasn't happened, and that's why on a weekly chart we are experiencing another downwards. So this is the move that really spooked in many investors, and outside of it I'd like to track different gauges in order to qualify or disqualify this recent price movement as the one has to be an entrance, has to become an entrance to a more severe bear market, ended up with capitulation we haven't seen yet. The capitulations are those very strong, abrupt move downwards only satisfactory high volume that typically are 1/3 bigger, or even up to twice bigger than normal daily volumes. So SPX, if we just have a look at right here at the previous bear market, this capitulation has coincided with such volume that has brought us to those valuations in terms of bars extensity that was very strong reaction over there. If we just try to compare those sell-offs during this COVID pandemic outbreak that was kind of a just half of it that led to those rather correction types of movement than real bear market to happen. So the volumes are very important in terms of analyzing the market, the face of the market. So we are starting off with major data of economy. So let's get into it. All right, and we are right now heading into 10-year Treasury constant maturity minus 2-year Treasury constant maturity, and this one is showing that we are definitely heading into a very severe time in the longer spectrum. Those reversals wasn't that steep since 2004, 2005. With that reversal to happen from this tendency, we may expect the deterioration of economic conditions, and that will be the one that may also cause some perturbances for the government. So right now we are still sliding, but with this this correlation being reverted, when it gets reverted, we may observe another major problems in the macroeconomics. The similar one may be that we gone through it during 80s, during this lost decade that been caused by very high inflation. So United States 10-year versus 2-year spread is showing exactly that tendency that is not optimistic. In terms of other elements that point to a leading indicator, that's definitely one of the most renowned for its foretelling features. That's Conference Board Leading Economic Index, in the abbreviation RLEI. So this lay indicator showing us that we are right now in a deteriorating scenario where we might be heading through major slump as it was back in 2008-2009, and exactly that's what the forecasts made by macroeconomic models and also the group of analysts make, that will slump to the levels of 120s, and with 120s we will oh, that's another measurement. So yeah, that's doesn't correlate right now. So we will slump on the amount of couple percent in terms of just like economic indexes. That's why it may bring to major indexes, US major indexes, another drop on the amount of a couple percent. In terms of market yield, US Treasury, in terms of 10-year constant maturity 2 and 30, we are right now finding that recently those that are shorter, in shorter periods of time, making higher yields for its investors than those on longer. It means that this smart money treasury market is expecting the recession to happen very soon. In terms of Fed funds rate, we are right now expecting that this will flatten at rate of 5, but we are still on the halfway through, so around halfway, so it's still more pain ahead regarding this. In terms of another element, that is NHB housing market index, we are expecting a pivot, but that's just the expectation of housing sellers that are rather expecting that this market to make a pivot by no very serious basis. That's why I won't treat this as a very reliant projection. In terms of this 25-year period, we are right now sliding with a very strong tendency, and normally it doesn't happen that we'll make such a very strong pivot unless something will happen very serious to the US economy, that or rather the Fed, that will change its trajectory abruptly, as it was back during this 80s 90s V-shaped correction. In terms of building permits, as you can find, we are expecting a plateau that will persist for longer. Building permits month over month are about to recover for a while, but housing starts are the one that we are expecting to also remain at the same level, but after that recent shocks, it may even get worse. So those housing projections are in the average okay, but many of them were already discounted by the market, so the market is questioning what's next. Tell me what I do not know. So among them, deteriorating environment for investors may bring us back lower to the market corrections days, as Mr. Powell said, that we also expecting the housing market to correct in order to make it more affordable for younger and also the middle class. So United States pending home sales right now is below the positive territory, but still not nosediving as it was back during this drop in 2010. In terms of pending home sales, we are expecting to thrive, but as I've mentioned, those projections are, I would say, very optimistically created. Case-share home price index showing a possibly double bottom formation. That's why we might be heading lower from here, and those leading indicators from housing showing that projections are merely good, merely satisfactory, good, but those projections for the economy expecting leading economic indexes are very steep to the downside. That's why I wouldn't so optimistic regarding this housing projections. ISM Purchasing Managers Index right now showing that we are heading close to 50ish, but we are about to make another low ahead. In terms of ISM non-manufacturing PMI, however, that's the one that we may rebound out of 50s, but that's still a one of the projection that still might be too optimistic to say. Also, Chicago PMIs are revolving around 50ish. However, composite PMI already has dropped below. So that means that we are finding that it will be very difficult for market to remain at this positive levels above 50ish. However, forecasts are still positive. So those eventual slides might not be priced in yet. If some of that PMIs slide even further, if we just make a outlook on a broader horizon, or I don't have for this one, but if we just make a stronger broad outlook, we may find out that during this global financial crisis, those PMIs went very severely below 50ish. That's why I do find that this time that will be very difficult to recover in that V-shape phase had been introduced on TradingView projections. Consumer Confidence Index (CCI) is showing that we are right now slumping into a very difficult territories below severely below hundreds. So that's the one. United States IBD TIPP Economic Optimism Index right now is about to make a turn after rebounding from 30ish area, but we are in a lowering tendency. That means that those headwinds are about to remain for longer, not just within a year, or maybe 2 or 3 or even more years in this decade. Consumer sentiment of Michigan also expecting a little drop, but not very steep. And right now retail sales, another leading indicator, showing that we are right now in a very indecisive territory, where right now, due to manufacturers' sales, we might be eventually make a pivot. There is still much of a this one to discount, and that's why I do expect that manufacturers' sales may drop with those affordabilities, affordability of buying such of a casual products may slump. Factory orders right now is going downwards, but in some terms we are expecting it to move upside, but that cannot be justified, I would say, for now by any of serious projection. It's just still optimism of analysts about the economy that don't find we might be heading into a recession. So this over optimism might be seen still among macroeconomists that don't find, or rather cannot really take that we might be right now heading into very serious time for the economy. Net long-term TIC flows right now showing territory above, a bit above neutral. In terms of business inventories, we might be heading lower, and retail inventories ex autos right now in terms of 25 years suffering major slide. In terms of wholesale inventories, however, we might be above neutral. Industrial productions, let's have a look once again. It's still above normal terms, but we are still possibly still on the days to have it deteriorated. Right now, this over-optimism is finding that we might be heading into another rebound and everything will get back to normal once again. Average hourly earnings are surging, but still in a similar fashion around the same point levels. Average hourly earnings, that's also about to remain the same area. However, non-farm labor productivity, we also expect this one to recover and make a switch to the upside. I'm showing you all of this just to justify that we are right now, in terms of analyst projections, not expecting the recession. However, leading economic indexes are finding that definitely we may go through a very hard time. So that means that many of investors, many of analysts are still taking consideration of what may come next by tracking those lagging indicators that we are right now going into now and starting this starting up with those categories from personal income and employment and labor market. So all of these lagging indicators are pointing that we might be heading to a more positive territory. Consumer price index is still about to get higher, so it means that also we are expecting that CPIs won't get stopped, and that would mean that the further interest rate hikes may go through and spook many of entrepreneurs. Initial jobless claims, we also finding that it will remain at these levels, but with this slowdown we may expect another move upwards. Personal consumption expenditure, still finding that those clients, customers still have enough purchasing power to remain and keep buying whatever it takes in terms of lowering this purchasing power of the funds. A PCE price index annual change is at a similar level. United States unemployment rate maybe it will be hiking a bit in terms of those slowdown that I have mentioned. A labor force participation rate is at around 62, and right now is have some finding some difficulties with getting back to those 63-ish for area. A non-farm unit labor cost is right now experiencing a major surge, and that means that with this CPI surging, also this labor costs are surging, but it will last until it won't. That's why this trend may revert in the months to come. Core inflation rate about to lower down, but with those CPIs it's still very confusing whether it happen this year or maybe next. Inflation rate, we are expecting this one to plateau. GDP growth rate, however, also to remain at neutral levels. A good trade balance are of a lesser importance. That's why I'm just switching at over more more quickly. United States import prices supposed to lower, but those are mainly lagging indicators. So we are just through all of those most important gauges. We are just observing during our daily market calendars, and I would like to just claim that we are right now in terms of very low levels on SPX. We have confirmed that this sell-off of on amount of 23% is somewhat intentional, and it wasn't just an accident at work. That's why I do find that we may observe breaking this 3600s and definitely get lowers to 32 at least. So many of those indicators I just look through in terms of forecasts don't expect this to drop. However, economic indexes finding that leading economic indexes finding that the worst is yet to come. So I'm just telling you this to tell you that risk management is very important, and don't trust blindly in what media is saying, because they are strictly moved by lagging indicators. Also, Fed is looking at labor market, whereas that's the one of the least important in terms of this whole market Lego, in which the most profitable trader will be the one that will read the market in its earliest stage of a trend that already is starting or developing in its trajectory. So that's it in today's episode. Hopefully you've enjoyed and took something for yourself. We are seeing tomorrow 8:45 live with video. Sorry if quality of my mic wasn't maybe satisfactory, but today I will return to the previous form of recording. Thank you very much.